Welcome back, folks. Dow's down 15, NADEX up 26, S&Ps are up 2.5, and it's Wednesday, so it is EIA 10:30.
You got it. Crude oil every Wednesday, 10:30 a.m. Eastern Time. It's about 10:19, so we got about 11 minutes until that number comes out. Oil, quite a little run to the positive side this morning. We're looking at a 5-minute chart. At about 4 a.m., it takes off from about 68.40 up to 69.20. We're sitting right at 69.
That's quite a move, man.
It is, right?
Yeah.
And backing up the chart a little bit more, we saw some volatility. This is yesterday's action. And then I believe, yeah, so we got the API number at 4:30. A little bit of volatility in there, but quite an acceleration, man. So I jumped to the crude oil spreads in here. We're in commodity spreads, crude oil. We get the numbers at 10:30, and what we're going to look at setting up here, what we like is a volatility trade with these numbers coming at 10:30, right? So what we want to look for is bullish and bearish position simultaneously. So we're going to jump to the 11 a.m. expiration spreads first, and what's nice is oil's at 69.01, and we're going to have spreads that begin at $69.
Oh, that's a good one.
Yeah, so we're talking about literally a penny of intrinsic value to the upside. So your bullish spread's costing about $17, which is about 17 pennies. You're buying in at 69.17, 17 pennies above the floor of that spread. You'd have profit potential up to 70.50. And then pretty similarly, on the flip side, here's your bearish spread from 69 down to 67.50. You're selling that spread. And the difference in price here is the difference in the fact that oil's about a couple pennies to the positive side.
Right.
So you got literally about $2 of intrinsic value you're paying.
We like it when it lines up like this.
It is, because you can see that, you know, basically both of these contracts have about 14 cents, $14, you know,
in premium.
Oh, premium, and then you just got the bullish ones and now as we're ticking away, you know, now we're talking about 4 pennies to the bullish side. You can see them shifting a little bit, but you're looking at about $30 for the 11 a.m., which would represent about 30 cents of movement you'd need away from $69 to start to break even, gain some profit.
And we've already moved $1.50 today.
Yeah,
I mean, from last night.
Yes, I mean, from yesterday's action, just big move across the board. So those will be your 11 a.m. expirations, okay? That would give us about a half hour after those numbers.
Yeah.
Jump into the noon expirations real quick. We're going to have a little bit different price point. They don't line up exactly perfectly because it changes to 69.25. And this is because as the day is progressing, they're launching these spreads. And as you can see, that of course they might line up differently when you get, you know, a dramatic move of almost $1 in the span of 5 hours.
Right.
So
what about the 230s?
Yeah, so that's not quite, but what is nice, and we jumped through it. So the 8 till 230s line up with $69 perfectly, okay? But the daily ones do as well. Now, these change a little bit in that on the 8 a.m.s till 230s, you're going to have $3 of profit potential exposure.
Right.
And then on the dailies, you have $5. And what we can go over real quick is that the 8s till 230s, so you have $3 from 69 up to 72.
Yeah.
And then you're going to have $3 from 69 down to 66. Now, most of the difference in the price here is going to come from the time that you're paying for, right? Because
41. The other one was $31.
$30, basically. So you're looking at 41. You need 41 cents away from 69. Right?
That's. And
if you ever got something really dramatic, as in you have more than $1.50, right? Where you get a $2 move by the end of the day, not impossible for sure with the way oil's been moving.
And you know what's so cool right here, folks, is that we're at a spot here at that $70, $69 spot that it hasn't been able to break through, but this would be the time that you could get either, you know, break topside or break downtown. Because this is where the bulls and bears are fighting.
Yeah, no, I mean, there's been, anytime you just see the type of volatility, man, I almost can't, you know, encapsulate the type of swings that we've had in this market just in the last couple of days, let alone last week.
Right.
So one final one, which is great. So here's our 8 till 230s, right? What I want to look at
that's a $3 spread.
That's a $3, but what normally happens in this is what we're going to bring up, is that here's your basically daily, which is set kind of last night as the market. So you have the same price, which is 69. And this is what I wanted to bring up, is that, so look at the bid offers here. In one, you're buying a spread that goes from 69 to 72. And they're giving it to you at 69.20. In the other one, you have the same exact 69.19. You can see them ticking simultaneously. But if you ever got to move above 72, you get that profit potential all the way up. So I would encourage people, if you're making this trade, you're paying nothing for that extra added exposure to the upside, right? And then it's probably going to be very, very similar on the way down. Here's your bearish one, and you can see the bid offer. So there's your one with $3. There's your one with $5. And again, you'd be selling the bearish spread. You'd be buying the bullish spread. And so there's about your $41. And what's great is, you know, so there's where you get to make the decision, right? Do you want to pay $30, which is basically 30 cents for your 11 a.m. expiration? Are you looking maybe just make a quick trade? You're out in 15 minutes. You don't want any exposure after the numbers.
Okay.
Or do you want exposure till 2:30, in which case you're paying about $41, which is 41 cents. For that type of action.
I like the 41 cents.
Yeah.
10 cents for 3 hours is not bad.
I would agree, and it's
actually
it's
3.5 hours.
2.5. No, you're at 3.5. We're looking at the 11 a.m.s.
Yeah, it's a long time.
It is, and if people follow the oil reaction to the EIA number that we get in 6 minutes now, the first move's not always the move that carries, right? As in, you get one move off the initial top line number, and then for the next, sometimes it takes off at 12 on one direction. At 12 Eastern time, noon, 1 o'clock. Decent pricing if you feel like the market's right for a pop. Yeah, right, exactly.
Right,
you know.
Right.
So yeah, good.
And folks, you just come over to our website if you haven't test driven yet the NADEX platform. You'll see the banner. Hit it. Bring it up. They'll put paper money into your account so that you can get used to how these defined option contracts trade.
And I said to you, normally we might come into this number and we start talking about it at maybe 23, 24 after, just go over kind of the scenarios, and we come out of that break at about 10, 18. I said, we should go over it right now because oil's moving so quickly that it's kind of nice that it's lined up. But it speaks to the fact that, because look at it, I mean, it's not, 9.45, we're up there at 69.20. Not a huge move, but you can see how that would shift this
20 cents.
And then, if it was up at 69.20, maybe you look for the noon expirations, which had 69.25 as that point.
Right.
So it's nice when it lines up. We're 1 penny away from that price point. Very little intrinsic value paying, and we get those numbers in less than 5 minutes. We'll see what happens.
Wild, man.
Totally.
Welcome back, folks. So crude inventories fell 2.57 million barrels. That's quite a difference in the API. API, they gained 37,000.
Okay, and the expectation, which is the big one, was they were looking for a decline of about 1.5 million barrels. So less oil in the market. We're probably going to see higher prices. Let's see what's happening. There we go. Not bad. So we're trading at $69, spiked up to about $69.40. Recapping some of those trades to and over, looking for the 11 a.m.s, you need about 30 cents a movement.
Yep.
You have the 230s, you need about 40 cents a movement. So immediately, you're at least break even to the positive side.
Right.
And again, we go over these scenarios, but here are our 230s. So this would be your bullish trade right now. You want to sell that out, you get $47, costing about 41. Give it a few seconds, you might get more than that.
And that's the one at 230.
That is the one at 230.
Yeah.
What I was going to even highlight is, so this is where your market bias, what are you looking for, right?
Yeah.
What do you really think has the most exposure as into upside, downside? Do you want to let this...
I'd be, if I had one, I'd be selling that right now.
Okay.
Yeah.
And so with that type of action, you say, okay, maybe we've gotten the exhaustive push on that initial number.
Yeah.
What's cool about doing that is that you could sell this out at $48, $49. You make a small profit on what you have. Percentage-wise, it's not bad.
Yeah, no.
And
33%.
But then what happens is you have exposure until 230 if you get a reversal. And if you have exposure with equity anywhere below $69, which is not outlandish when you talk about, we're talking about now, what, 4 hours? Yeah, 4 hours from right now.
Right.
In this market. So.
And the reason that I'd sell it, folks, let me just bring up the Bloomberg just for a second. Let me show you something. Because this is where it's happened. It doesn't mean it's going to happen now. But what has happened each and every time that climbs up to this level is where you have had some major sellers. Like right here, what is that? That's the 25th of May. It went from 69.72 to 66. That is the 11th of July. You went from 70.94 to 66.57. Both of those folks was in one day. So, you're pressing into where the sellers were before.
Yeah.
So where I'd look at that trade is that, okay, hold it, I made money on that side. Now let's just see what we can do.
For every trader that thinks that, there's a guy or a woman on the other side that says, you know what, it's going to blow right through that level and go to the other side.
And that's what made this level so good for the volatility trade in general, too, folks. Because the bulls and bears are going to be fighting like crazy over this level. There's no doubt. You know what I mean?
We'll see what happens. I mean, quite a run. You back this up, right? It's just extending. I mean, we're now up a solid $1 from where we were 6.5 hours ago.
Right.
Pretty remarkable.
Right. And the deviant part about it, has to do, we had two different numbers, and there was quite a difference in those numbers between 37,000 billed last night at 4:30 versus a 2.7 million
Yeah, those APIs,
downdraft.
they differ a little bit sometimes. I always like to look at the analyst estimate, the Bloomberg estimate. You know, what's the expectation coming into this morning? And that's where, so the PEG number was a decline of 1.5. You got a decline of 2.5. Less oil, higher prices, man.
Welcome back, folks. Oil. So,
was oil listening to us in that conversation?
I'm
because
telling you.
where are we? We're back under $69 right now, trading at $68.95. We got that spike up to a high of $69.48. It's kind of convenient. We talked about, you know, what are you looking for? Maybe you'd sell it. You'd have that possibility. If you did sell it, you would always have exposure under $69. There would be your bearish spread that lasts until 2:30. And one of the things we pulled up during the break, I noticed, is just that, you know, so your max loss in these trades when you're using $69 would be that 69 price point because you want exposure to the upside and downside. That's actually your max loss at 69. And what's interesting here is that we're only 4 pennies away from that price point right now. But they have so much premium in these instruments still after the number. So you're going to see that premium get sucked out at 10:30, some of it, right? Because some of that premium's waiting for the EIA number. But there's still a relative decent amount of premium in these.
Because it's jumping around.
Yeah, and because you got till 2:30, right? As in, so that's where it's like, you know, it's almost amazing to see how little premium they were charging you for that 10:30 number specifically, because there's still all this premium in there, which is just time premium.
Now, let me see. What would happen if you closed the short part of this trade?
Well, so
because I would say that we already closed the long part.
So this is your bearish spread right here, and you could buy it back at 68.79. So you'd get, whoops, excuse me. There's your $21 you'd be taking in, which is the difference between 69 to the 21 cents underneath it, which is $21, which is huge when you're looking at the whole trade was costing us 41. If you had taken it off after the first spike, you got about $45 to $48, and then you'd have another 20. I mean, what's interesting is if you hadn't even closed it out and you said, you know what, I just don't even like this trade. It didn't do what I want. It kind of had a spike. It's back there.
You get your money back.
You could close out both. You could sell the bullish one, get 13. You could buy the bearish one, get 22. You get 35 bucks back out of the 41. And the market barely moved. I mean, that's a decent risk reward.
And you can wait a little bit longer. You got to 2:30, folks, and oil's going down.
Bearish spread. There you go. We'll see what happens.
Stay right there, folks. Kevin Hinks and his team's coming right up. Thanks, pal.
Thanks, man.
Go get him, folks.